The Relative Strength Index has been one of the most popular indicators since it was released in the 1970s. Can we give it a little modern twist by making it smoother and more responsive? This is what the Laguerre RSI tries to achieve. In this video, I'll explain what the Laguerre RSI is and use it to build an automated trend following strategy for the Aussie dollar. First introduced by John Ehlers in 2004, the Laguerre RSI is similar to a regular 4-period RSI, except that a Laguerre transform has been applied to closing prices. The Laguerre transform is a mathematical technique that Ehlers used to build smooth indicators using small amounts of data. The underlying calculations are beyond the scope of this video, but if you are interested, I have included a link to Ehlers' paper in the description. Compared to the regular RSI, the Laguerre RSI is much smoother, but still does a good job at capturing the larger price moves. Therefore, you get an improved RSI that reacts quickly while minimizing whipsaws. There is only one input parameter for the Laguerre RSI, the gamma, which is a damping factor that determines the amount of price smoothing. The larger the gamma, the smoother, but more laggy, the Laguerre RSI becomes. Here is a comparison between a 0.5 and a 0.8 gamma. The 0.5 gamma is way too choppy for my liking, so I will use a gamma of 0.8 for the rest of this video. Like other momentum oscillators, the Laguerre RSI is most commonly used to detect overbought and oversold conditions. Unlike the regular RSI, it oscillates between 0 and 1, not 100, and I have found it to be more responsive. My preference is to use 0.85 to denote overbought conditions and 0.15 to denote oversold conditions. If you are trading a sideways market like this one, you can go long when the Laguerre RSI crosses above 0.15, indicating that prices will likely revert towards the mean. Or, if you're a trend follower, you can use the Laguerre RSI to detect the short-term counter-trend momentum during a pullback. When the Laguerre RSI crosses above 0.15 in a trending market, it indicates the market is exiting the pullback and the main trend is resuming. Let's try this trend following approach and add a couple of supporting entry conditions. I want to trade in the direction of the longer-term trend, so for longs, I will first look for prices to close above the 50-period EMA. I also want to exploit the higher volatility during the London session, so I will limit my entries to the 10 to 1800 hour window. Looking at the chart, this 10 AM bar here satisfies our entry conditions. The Laguerre RSI has just crossed above 0.15, and prices have closed above the 50-period EMA. For exits, I will add a 80 bar time stop, which on the 1 hour Aussie dollar translates to about 3 trading days. The Aussie dollar does not trend much, so using a time stop to limit your market exposure sounds like a good idea. Finally, to protect my downside, I will add a 120 pip stop loss. The above strategy was quickly programmed in AlgoWizard. For a step-by-step guide on how to use AlgoWizard to program your strategy without coding, be sure to check out the link in the top right. Here's the list of variables I added. For the Laguerre RSI, I have the gamma and the overbought and oversold levels. The EMA trend filter has a look-back period, and for trade management, we have the time stop and stop loss. If you do not wish to optimize any of these parameters, you can skip this step and use fixed values in your entry conditions. The Laguerre RSI and trend filter conditions are here, while the time filter is under trading options. For trade management, just check what we need and assign the variables we created. Our backtest will be on the 1 hour Aussie dollar over the last 11 years, with a 2 pip spread. The performance metrics show a decent profit factor and return over drawdown ratio. The only issue is the long stagnation of about 1600 days, which you can see clearly on the equity curve. It's best to trade this strategy as part of a diversified portfolio. When looking at the Trade Analysis tab, it was interesting to find that the best performing trades were open for more than 4 days. I opened the list of trades and sorted by trade duration. All the trades you see here were kept open over the weekend, and they generally performed well. Does this mean you should keep your trades open over the weekend? To find out, I added a condition that exits my trades an hour before the Friday close, and redid the backtest. The strategy definitely performs worse now. For this particular strategy, it seems that a weekend close will not benefit performance. So while a weekend close is psychologically satisfying, it could actually hurt your performance. If in doubt, be sure to do a backtest and let the results do the talking. If you want more trading strategies, be sure to subscribe and share this video with your friends. I look forward to creating more great content for you guys.